All right, let's continue this conversation now. We've got Ghabour from KeyAdvisors Group and author of Common Sense Bull here with us now. Eddie, it's always great to have you with us.
Thank you.
So let's just start with what's going on in equities. Now, you're still bullish equities, but you mentioned in your notes that you are worried in the near term. How near is the near term for you? And do you then see this as a buying opportunity?
So we told our clients at the end of this quarter that we thought that we were going to see peak GDP and peak earnings this next quarter. It's going to be reported in July, but it's going to be second quarter data. So that's going to really be the peak. And we'll probably get, in our opinion, one last real push up into the equity markets through the month of July into August. And then as we get to the late third quarter, we are concerned that we're going to start to see a decrease in economic activity due to the inflation, such as housing increases, food increases, gas increases, really starting to hurt the consumer spending. So when we transition to that next phase economically, even though we don't believe we're going to be in a recession, we're going to see a reduction in GDP activity and earnings, and the market usually sells off ahead of that. So we look at this near-term sell-off. It's not much of a sell-off in our opinion. We don't think this is the beginning of the sell-off we're expecting late third quarter. So we do look at it as an opportunity, but we would look through the month of July, beginning of August, to start to play a little bit of defense with the equity holdings that you have, depending upon your risk tolerance and your situation.
All right, so let's talk about that. Where are you seeing opportunity, and how should investors really start playing defensive?
So our favorite sector looking 12 months out is energy. We think oil prices, in our opinion, is the one commodity that even if we see a slowdown economically on the consumer, that will more than likely continue to rise due to the supply constraints. So that's our favorite sector. In regards to playing defense, it's a matter of rotating out slowly out of some of your cyclical recovery plays and looking into some more of the consumer staples. You can look at some REITs that are do favorable in that type of environment that we may be in. You can look at things like utilities and gold, things that we really haven't owned when we were playing the recovery trade. But again, I think it's safe to say that we've seen the biggest surge we're going to see in regards to spending and economic activity these first 6 months of this year. And it's going to be really difficult to replicate what we just saw. At the end of the day, I would rather de-risk early than late. And just hope that the correction is more of a shallow correction.
Eddie, I'm really glad that you mentioned oil because so many people have been talking about the demand, the pent-up demand for energy. But we have this Delta variant right now that is surging. We are seeing a lot of countries starting to reimpose their restrictions. Some closing borders again, the UK, which has always been really a leading indicator for the United States, putting more and more countries on its red and its amber list, which would force its own citizens to go into quarantine. Do you think that this Delta variant right now could present a headwind to the markets, or do you think that perhaps investors right now are ignoring what's happening with coronavirus, and could it be to their peril?
Look, I do think the Delta variant is probably the biggest short-term risk or surprise to the market, because the equity markets, even though the bonds have really sold off, as we have seen here, especially today, hitting the 1.25 range, the equity markets haven't priced the Delta variant as a big risk. And I think one of the reasons why is, you look at the United States, for example, with our vaccination rates are much better than other countries that I'm not a doctor, but I don't think the market is pricing in that we will see some type of repeat of what we had originally. So I could see a scenario where there's a headline one morning in the media that the Delta virus is really starting to hit hard and causing a sell-off. I think that would really be an opportunity for investors, because here's the interesting thing with the energy play. Even if oil stays right where it's at now or even goes down a little bit, the earnings on these companies are going to be massive. And they've already said that 20 to 30% of the free cash flow, they're going to look to pass to investors. So you can get a handsome dividend and a commodity that, in our opinion, will stay somewhat stable in this environment. And the earnings at $70+ a barrel of oil, it's going to be through the roof for these companies. So they're going to be very, very profitable.
I want to, circle back to what we were chatting about in the beginning, which is, of course, what's happening in equities. And of course, even with this 10-year bond yield, we are seeing slide down over 2% right now to a level of 1.29%. Now, just a couple of weeks ago, we were having conversations about those movements in the dot plots and fears about the economy overheating and how the Fed essentially was reading the tea leaves wrong about inflation. And now it seems we have done a complete about face, at least in some of that thinking. But we've already seen some Fed officials come out and make statements about how some rate hikes, I'm thinking of the Fed's James Bullard talking about how some rate hikes might need to actually come in 2022. What position do you see the Fed being in right now as some of these inflation fears are really getting shrugged off?
This is a big concern of mine. I think the Fed has put themselves in a corner here where they could actually be forced to tighten during a decelerating economy. Normally they tighten when the economy is robust, but because they've waited so long to start tightening, that if they do tighten next year, which I think they will, in my opinion, we're not going to be in a robust economy like we were the first 6 months. So that's going to present a problem because, look, inflation is real. Like I said, look at housing. Rents are going to increase substantially when these moratoriums lift. You could see a 9% increase in rents year over year, 12 months from now. Labor costs are through the roof, and oil and energy costs are through the roof relative to where they were 12 months ago. So, we think inflation is a real problem. We don't think it's transitory. And again, we think the Fed put themselves in a position where they may be forced to tighten when it's not the most optimum time to tighten due to them kicking the can down the road.
All right, Eddie Ghabour, author of The Common Sense Bull. Thanks so much for joining us as always.